Now in this edition, we're going to be talking about understanding credit. More importantly, how our FICO scoring system works, the algorithm that takes place, how we can use that information to make better credit decisions, and how we can increase our score over time. The FICO scoring system ranges from a score as low as 300 all the way up to 850. Now, I've examined over 5,000 credit bureaus, and I'll tell you it's very hard to get under a 400. But when we talk about our scoring probability, it is actually going to mark down the percent chance of failure, not the percent chance of success. So the higher your score is, the higher probability that you will not fail. I know it's a weird way of determining that. But once again, the scoring ranges from 300 to 850. If we look at scores above 800 to 850, they have a less than 1% chance of being seriously delinquent. Seriously delinquent means approximately 90 days behind a single credit bill. Now, as we take that down, between scores of 740 to 799, that goes up to about 2.5% chance that they will be seriously delinquent. It means about 1 in every 40 people in this group will be seriously delinquent at one point in time. As we take that scoring system further back down, from scores 670 to 739, our chances of failure for serious delinquency increase to 8.5%. Scores still above 670 are considered average, as I will eventually determine the average score right now in the United States is 678. That is the median score. But once we get past that range of 670, when we look at a different range of 580 to 669, there's a 28% chance that a person in this range will eventually be seriously delinquent. 28% is essentially 2 out of every 7 people. And finally, scores below 579 now have a 61% chance of being delinquent, about 3 in every 5 people in this score. As a result, the lower your score is, the higher the interest rate that you will pay for certain products, whether it be a loan, for an auto, for a mortgage, for a credit card. Your rate is really determined a lot by your FICO score. Now that you know the scoring ranges from 300 to 850, I'm going to talk about the 5 metrics of how we can play within that. 35% of your score is determined by your payment history. Payment history is anything that is less than 30 days past due. So for example, if you had an auto loan payment out there and you missed the due date, and you paid a late fee after 10 days, you will pay money as a late fee. It will not affect your credit score because unless you make that payment after 30 days late, you still get credit for making an on-time payment. Once again, that is 35% of your score. When we look at 30% is going to be amounts owed, and this really comes into play on revolving debt. Revolving debt are line of credits, and more importantly, credit cards. It takes your last statement balance divided by your limit. When we look at your last statement balance, let's just say it was $850, but your limit was $1,200. It looks at not that you have $350 available for you, that you've used $850 of your $1,200. The one thing that the credit bureaus do not determine is how much you make for a payment. The only thing that will report was your last statement balance and what your limit is, and did you make a payment. Now, this is the one factor that causes most Americans to be less than perfect. Our goal out there is to have 30% of our limit being utilized on a monthly basis. When we look at that, let's just say you had a $5,000 limit. Our goal out there is to have a balance of $1,500 or less every single month going forward. Now, we have the ability with credit cards to make payments during the month that will take away your outstanding balance. That's one way that we can play the game to help improve your score. As I repeat, 30% is this range of how it determines the algorithm, and this is what affects most Americans from having a score less than 700. 15% of your score is going to be length of history. Your last 24 months matter the most. Just like in relationships, the longer out in time, the better your score will be as well. So if you ever had a hiccup for whatever reason, knowing you won't be penalized forever, but in your last 24 months does matter the most. Our goal out there is to try to establish credit as long as we can. I still have a credit card from 1998 because I now have 20 years of established history with that company. As long as they don't charge an annual fee and I use it occasionally, I will not have my card being closed out, and I continue that length of history because I have over 20 years of history with that. Now the credit card companies do have an ability to close out an inactive card after 18 months of inactive use. So as long as you make a purchase, say once every 18 months, I can continue that credit card and continue that credit history. The final 10% is going to be broken down into two different categories. One is going to be your credit mix, and the final is going to be new credit inquiries. I'll talk about a credit mix as far as what is going to cost you the most points, so it costs you the least points out there. Your mortgage is going to be number one because for most people, it is the largest loan that they'll ever have, and it also has the longest amortization, up to 30 years. Number two is going to be a surprise because it's actually student loans. Student loans are the only thing out there currently that is absolved from bankruptcy debt because it is actually debt owed to the federal government, which means that even after you passed on, if you have student loan debts, they would go after your estate. Number three is going to be secured debt, which is going to be anything with collateral. The easiest ones out there are obviously auto loans, boat loans. Anything that has collateral will be known as a secured loan. Number four is going to be unsecured debt. That's anything such as a line of credit that we use for debt consolidation, overdraft protection, or an unsecured loan. Number five is going to be major credit cards. That's anything sponsored by a bank or credit union, American Express, Discover, or Capital One. And finally, six are going to be retail credit cards. That's any place that you go and shop that offers credit on the side. Be it a Target, a Home Depot, a Sears, doesn't matter. If they offer credit and they sell you something, that is known as retail credit card. So if you missed a payment on your mortgage, which takes place of holding the highest versus a retail credit card, you will be dinged more points by missing your mortgage payment in this criteria. And finally, the last 10% is going to be how many times you get new credit out there, or how many times you get your credit pulled. Ideally, we want to have less than 4 credit pulls in a given 12-month period. It doesn't mean it starts over every January 1st because it is a rolling 12-month average. And there's going to be sometimes that we get our credit pulled that we don't think of. Sometimes when you apply for rent, they're going to pull your credit. When you get a new cell phone plan, they're going to pull your credit. Anytime you get a new internet or TV or satellite, they're going to pull your credit. Car insurance has the ability to pull your credit. These are what we call the non-bank function, non-financial institutions that are going to be able to pull your credit card that count as credit pulls that sometimes we're unaware of. Next, you're going to see an example of an auto loan and the difference between good credit and bad credit.
Now, the reason why credit matters is when we'll be talking about auto loans. On the low end, a person could pay as small as 3.75% for an auto loan, like this. On the high end, you'd be paying as high as 16.75%. That difference of monthly payment would be $366 on the low end, up to about $495 a month on the high end. The amount of interest that you're going to pay on the low end would be $1,965, and on the high end would be close to $10,000 at $9,663 worth of interest. That difference between a low and a high end is about $7,700. That's the difference of you and me feel like we're driving this, you feel that you're driving some beater out there. Is the difference of $7,700 over that 5-year period. Once again, this is why credit matters.
Now I'm going to show you an example of a home mortgage, the difference between good credit and bad credit. Now, as we're going to talk about home mortgage today, this is why credit will be so important, as we're going to be talking about your monthly payment, your interest over time, and what it looks like if we could add a little bit more to the principal balance. Let's just say, for example, we're going to take out a $150,000 mortgage. Using today's interest rates at 4.375%, that equals about a $749 monthly payment. That means over the course of 30 years, you'll pay approximately about $119,615 worth of interest over those 30 years. Now conversely, with poor credit, let's just say you're going to get that same $150,000 loan amount at 6.25% interest rate. That means your monthly payment will skyrocket to $924 per month in principal and interest. And over time, those 30 years, you're going to pay approximately $182,489 worth of interest. That gap of that small monthly payment from $924 minus $749 is going to equate to approximately $63,000 more in interest for the exact same home. This is why credit matters. Now let's just say, using that same example of a $150,000 mortgage, if you're just able to put an extra $100 a month every single month on your mortgage, you're going to shorten your payment of a 30-year mortgage down to 24 years. You're going to save 6 years worth of payments by just making an extra $100 per month. This is why credit matters.
Now we'll be talking about student loans. Right now, the student loans, what we care about is how interest is calculated, how they work, and how our repayment terms back in the course of one's lifetime. Right now, the student loans have a huge range when it comes down to rate. We stem from 5.74% on the low end, as high as 12.39% on the high end, with 7.1 being the average. When you take out a student loan, you're actually paying interest from that very first day until you graduate, with on average a 6-month deferment period shortly thereafter you graduate. Right now, student loans will have a range of repayment terms as small as 10 years and as high as 20 years. The longer term that you take out there will determine how much your monthly payment is, but will also show you how much more you're going to pay in interest over that time. If we use an example that you took out $10,000 on your very first semester out there when you go to college, by the time you graduate, your average interest that you've paid plus the original $10,000 is now $13,624 as your current balance. When you choose a 10-year term, your monthly payment will be $159 per month. On a 15 years, it'll be $123 a month. And if you go out 20 years, your payment will be smaller at $106 a month, but you'll be paying so much more in interest, as I will show you. Now remember, this is an example for just one semester. As we can attest that most people will be going to school more than one semester, so if we took out our example of $10,000 semester 1, $10,000 semester 2 is your freshman year. You're going to have to multiply that out between 2 to 4 years depending upon when you plan to graduate school. And I will be using these examples as we go out to show how much interest you'll be paying on your student loans. But more importantly, our goal out there is to show you how to maximize your money over time by having the least amount of student loan debt. Thank you.
Our Understanding Credit wrap-up will start by starting smart. We want to limit our overall exposure to credit card usage in the beginning so we can increase our score as we obtain future credit and reduce our interest expense. Remember that 30% rule of using your credit card, which is going to be your monthly balance divided by the limit. If you can obtain that, you will always be in a great position for improving your credit score. The more you save by putting money down for loans will decrease your overall loan payment each month and cut down on the amount of interest paid over time. If you can afford to put a little bit extra funds every single month towards your loan payment of any loan you have, you'll see a huge difference in the amount of time it will be paid off earlier. And lastly, the higher your overall credit score, the better rates you will get for loans, which then in return gives you future savings. This is why credit matters.